original idea came from Anis Hooley from 500 Startups, who can't make it right now, but we will somehow put him on the screen. And he said that, okay, if we come together, we will talk about venture capital investments, how to grow. Okay, let's go deeper, not just talking about investments in 15 minutes or 20 minutes presentations, but let's go deeper and let's invite investors who have a huge experience, so successful grown-ups, scale-ups, maybe unicorns, and what's the secret? How could they grow out of the CEE region? And when there is a team of entrepreneurs, founders, they want to grow internationally, maybe globally, then what are the challenges? So we invited wonderful, really experienced and great investors, Guillaume Fournier from Credo Ventures, please, and watch your steps. Marcin, Hejka from OTB Ventures, please, gentlemen, come to the stage. So you will have their chairs, but feel free to mics and water and everything you have. And so we asked the gentlemen that they will introduce their funds and investment approach, just in case you want to know what they are dealing with. But they collected a handful of good advices that what they see, what they saw in the past, what challenges typical startup is facing.
And so Leonard basically asked us to kind of talk to you this afternoon about the challenges for Central and Eastern European startups, and more specifically Hungarian ones. The challenges of kind of going international and making it big, let's say. So we'll try and cover these few topics in the coming minutes, with an emphasis on trying to illustrate each of the points we're making with stories or anecdotes from our respective portfolio, because let's face it, the theory is pretty basic, but it's more interesting to hear about real-life examples. But so first of all, let us ask, briefly bring to your attention this map of Central and Eastern Europe, which is roughly the mandate that both OTB and Credo Venture covers. And if you'll notice on this map of potentially the biggest success stories of the region, there's one common point among all these companies. And this common point is that they all had to go international. But otherwise, all of these companies, they originated from the region, obviously, but they were never considering the region as their target market. And another way to think about it, and here I'm stealing an illustration from Christoph Jans from Point 9 Capital, if you've heard of him, which is the 5 different ways of building a big business, a €100 million revenue business, for lack of a better analogy. And simple, you do the math, either you're gonna, based on your average revenue per account or user, you'll have to consider what's your target market and target audience. And it's simple, if you want to have a big enterprise type of business, have average contract values of €100,000, then you'll need 1,000 customers. At the bottom of the scale, the flies, they call flies, with an average contract value of $10, you'll need 10 million users. Not many markets in the region can accommodate this.
To mention a couple of comments. So number one, we should be proud of this picture. So the region is really rich in talent. I would say that if there are any 2 places on earth to mention where you see very large population of high-quality engineers and software programmers, those 2 places would be Silicon Valley and Central Europe. And here you see the evidence of it. The region has a proven track record of producing global successes, globally relevant technologies. One thing in common, with the exception of Allegro here, is that those companies actually became global, and became global because of some unique, super good technologies that were developed by talented local teams. So shortage of talent is not a problem here. The problem is the market. If you take a look at global technology consumption markets, it's not Central Europe. You know, let me use as an example global consumption of software. You know that nearly 50% of global consumption of software takes place in one country, United States. Nearly 30% of global consumption of software is Western Europe. Nearly 10% is China. Central Europe, from perspective of technology consumption, is periphery of periphery. So what we know at this point of time is that there is a lot of talent here. It is possible to build globally successful technologies here, but scaling here is a no-go. There's no way to build a unicorn purely based on domestic market. Of course, as Guillaume mentioned, with some exceptions like Allegro. And one interesting thing is that if you take a look at those companies like Avast, AVG, Asset, LogMeIn, UiPath, you will figure out, if you take a look at kind of, you know, where their revenue is coming from, it comes more or less exactly as I mentioned the global software consumption looks like. You know, pretty much all of those companies need to have nearly 50% of revenue coming from the US. Let's put it this way. So basically, the only way to be successful as entrepreneur, to be successful as investor, is to go global. And it's not easy.
Right, so just before we dive in, brief additional points on who we are. As I mentioned, Credo Ventures, this is our portfolio, focusing on seed and Series A investments in the Central and Eastern European region. But as Marcin mentioned, originating, meaning targeting global opportunities, not being afraid to go to the US or Western or Asia, wherever the market is. These are the companies where we've invested in. Obviously, UiPath is currently considered our biggest success, but we're equally proud of all the other ones in the portfolio.
Any Hungarian companies?
Yeah, three of them actually. Consignia is doing vehicle-to-everything communication. I don't know where the logo ended up in this thing.
There's
Signal doing translation of sign language using computer vision. And Publish Drive must be somewhere in there, I hope, otherwise don't tell them. Offering a platform for independent authors to release their ebooks across the board efficiently and simply. And OTB?
And OTB, we are relatively new, so OTB got established at the end of 2017. So far, we completed, you know, you can see some logos of companies I previously invested in below my picture, but the 4 companies that we invested in the last 9 months are in chronological order. SpaceNow, which is satellite image analytics company, basically extracting business relevant recommendations out of satellite images. The company is registered in the US but based in Czech Republic. Minute, which is robotic, which is kind of adjacent to robotic process automation. So Guillaume mentioned UiPath, which is the global leader in robotic process automation. But before you implement robotic process automation, you need to have very good mapping of processes within the enterprise. And traditionally, it was being done manually. The company had to hire Accenture, EY, Capgemini, who are coming in, running a project for a couple of months and mapping processes. Minute is able to do this automatically within a day or less and keep monitoring real time, you know, the processes within the enterprise with tremendous precision. They are able to, for example, in a corporation with 20,000 people, figure out which employee is tired. And this segment is expected to grow super rapidly. According to Gartner, it will be bigger than RPA in 5 years.
What's next?
So what's next? We'll try and roughly go over the various topics that need addressing when you're considering going global. I think broadly these are the usual topics, but with, again, this angle of how to go international. So we'll be talking about team, timing, go-to-market strategy, but let's go over this. So first one is talent or the team. And I think here, and again, we'll try to illustrate this with some of our portfolio examples, but what we meant to say is that when you think of going global, you might need to start considering the talent that's going to help you get there. And that talent will most likely involve sales and commercial talent, which, as much as Marcin mentioned that there's amazing engineering talent in the region, on the sales and commercial side, it's a bit more lacking, especially if you want to go and tackle the US market. And so most likely at some point, you will need to start hiring beyond your initial circle and beyond your initial community, let's say, of developers and local market potential. That talent comes at a price, and we'll actually go over this afterwards, but the main concern and the main thing we'd like you to have in mind is that when you start a company, you go on an adventure, potentially with your best friend or potentially with someone you deeply trust as your co-founder. At some point comes the time when the company will have to professionalize, and it's no longer about working on a cool project with your friends. It's about hiring senior talent for the price and tackling the US. So if you have anything to add to this, or I'll add some examples to give.
So I would, the only comment I would make is that, we have quite a lot of technical talent, and maybe one only thing I would add to it is that, companies, we already mentioned that in order to be really successful, in order to really scale the business, it's necessary to win internationally. Which means that, no matter what market the company will be going after, it will have to compete against well-funded Western European, Silicon Valley, and Israeli companies. And the company needs to get ready for this competition. What is generally helping is having some sort of unique technological advantage. And we are probably one of the very few regions where local talent can produce something that is a unique technological advantage, which can, to a certain extent, offset the fact that those other companies will be most likely better funded, better connected, they may have better access to customers as a result, etc. So it's important when thinking about international expansion to have some sort of advantage and using the advantage of the region to compete more successfully when expanding internationally.
And you mentioned the sales and marketing competence and capacity as well. So we see regularly business plans where the tech team put together an HR plan for the next years, and you will see there 25, 30 developers, architects, etc., and one sales guy and one marketing assistant. So could you give us a benchmark, or what? If you can tell what is the ratio at UiPath or in such stage, like 30, 50 people, how should it look like? And considering there is at least a product, so it's not like they have a beta version, but something they already sell.
So I don't know specifically the answer to that at UiPath, but I think they have about 1,000 people now. So I don't think I'm too far off the mark when I say that they're hiring extremely fast, and the vast majority of that hiring is now sales. They're opening up offices in every market. All these offices are sales offices. The tech is in New York and Bucharest. I'm sure they're still growing that quite fast, and a good chunk of these 1,000 people is still on the tech team to continue to be the best product out there in this RPA space. But the success came on the back of hiring salespeople.
The ratio keeps growing with time. So, there are different stages of development of the company, but, obviously it's necessary, initially it's necessary to build the technology. So naturally, early teams are dominated by engineers. Then it's necessary to validate it, to get some references. And once and here you need, few salesmen probably to start with to win some initial references. Once the product is working, once the product can be sold, it solves real problem of customers, it's time to basically, go ahead full steam with building sales and business development organizations, because of a very simple reason. Every unused opportunity ultimately becomes a threat. If you don't win the customer, so your competitor will. And at some point of time, your brand is becoming one of the key barriers for competition. So basically, once you know your technology is working and can be solved, it's necessary to basically press full steam on the acceleration and build sales team. And I saw several companies where basically the proportion between technology and sales and business development organization was like 1 to 5 ultimately. But it's not going to happen early.
The first salesperson of the company needs to be the founder, basically. He needs to be the one out there knocking on the doors and making those first sales, because that's the answers he's going to get and the feedback he's going to get from the market are at such an early stage are one of the most precious resources the company has in terms of improving its product, understanding what the market demands. There's a huge fallacy of trying to build a product in a vacuum, let's say, which might be a great product, and then releasing it to the world where you expect that because it's a great product, people will buy it, and no, they won't. Either because they haven't heard about it, or because it's great product in this vacuum, but it doesn't fit within existing processes or models. And the more into B2B and the more enterprise your sales effort becomes, the more it becomes about fitting with existing solutions and existing processes, which is a whole reason Minute does process mining, UiPath does RPA. So it's not the sexiest of jobs, but it's the reality of the enterprise world. Cost. And so, cost, I think, was the natural transition from your point of how to hire such talent. It costs money, so the easiest way is to raise VC money. That will help you finance the investments you need to make into those hires. That's the number one thing that the startups we speak with spend the money on. And also to not underestimate the costs of going to the US if you ever consider launching there. I think I can give the example of one of our portfolio company, PriceFX, which is based well, it's technically a German company, but they're based in Prague. We invested a Series A of 4 million euro. They used that to open an office in Chicago. They gave up on Silicon Valley, it was way too expensive. But even Chicago, I think the budget for the first year of opening an office there, with a small team of, I think, maximum 10, but I think less than that, was $500,000. That was the budget for getting the office, fitting it out, the rent. And I think now the ongoing cost of all the expenses without the salaries is about $22,000 per month. That's just the rent and the fixed costs. So I think, and that's going to come out through the other points we make later on, but there's a sense of timing as well that becomes important, and that timing is heavily linked to when you can afford to start going international, and that often means when can you raise VC money to finance it.
Yeah, the name of the game in venture world is velocity. So it is absolutely standard in venture world to burn money. No one is expecting venture-backed companies at the early stage to be profitable. Actually, being profitable is an aberration. But everyone is, seriously, I think that, not being profitable means you're not growing fast enough.
There are some startups who would say that they can name some Hungarian investors, VC investors, willing to see profitable companies in months. I
think it all comes down to the
mentality. Mentality now worldwide, and this model is actually moving up. So actually, the funny thing is that you suddenly you don't only see unprofitable startups that burn money. You actually see public companies that keep burning money, or companies with tremendous valuation that keep burning money. Tesla, that is a public company, keeps burning money every quarter. Uber keeps burning money every quarter. WeWork keeps burning tons of money every quarter, but they are delivering growth. And this is what is really the key element here.
And still there is margin, so they are investing in their growth, but...
Exactly. So, actually, growth is the name of the game. So I think that it is important to have a viable business model. It's crazy not to burn money without logic unnecessarily, but burning money in order to achieve over proportional growth and dominate the market is absolutely justified and is even expected. So the growth mentality, which is related to basically accelerating the growth of the company, hiring, expanding internationally, developing product, entering new markets, is really the critical part of this business.
And there's a rule of thumb, I forget who coined it, but the 40% rule of thumb to get a sense of whether you're growing fast enough. And that rule is that the sum of your growth rates and your bottom line margin should be more than 40%. So it's okay if you're growing 100%, so doubling year on year, it's okay to be at minus 60% bottom line. So effectively spending 1.6 times more than you're making. If the growth stops, it's not the end of the world. It just means that's when you need to start thinking of turning profitable, because investors will run away.
Why is growth important? Very simple reason. Because investors buy the future. They don't care about the past. They care little about the present. Every investor buys the future. If you don't if you don't grow, you're worthless. And actually, the same applies to public investors. Take a look at correlation between growth rate and multiples, even for public companies. That's why growth is so important.
Logistics. So here, I think we wanted to bring highlight to the fact that it is hard to be a distributed team. There are startups that actually start distributed with people all over the place from the beginning. So these guys have a separate challenge that we can discuss later on, which is one day they're going to need to have an office. There's at some point you need an office. But in this case, we meant more, you're a Hungarian team, everybody's based in Budapest or at least in Hungary, and all of a sudden you're going to start either hiring or having your founder move to the US or whichever market, but let's use the US because it's the best example. It's tough. I can give the example of Credo, for example. One of our partners a year ago moved to Silicon Valley. He's alone over there, whereas the rest of the team is in Prague. It's lonely, let's face it, and there's the time difference. So to ensure that the communication, and it's easy for us. We're fairly independent. We can do our own thing. We don't need to. We have one meeting per week where we get all together and chat. But when you're a startup, communication and the speed of that communication is often very important. So when all of a sudden one of your team member who relies on the efforts of the others is 9 hours earlier in time, 9-hour time difference from you, it becomes a challenge.
Vision without execution is hallucination. So logistics and execution are the key. Sometimes operational excellence becomes the key advantage.
Agree. So let's just summarize that it's strongly recommended that if a startup, for instance, as you said, the 50% of software business is happening in the US. So if a startup is willing to enter the US market, then it means one of the founders must move there.
Yeah. So linking back to the point on cost and maybe on the following points on go-to-market, but there's no two ways around it. You need to spend time there. And back to the point that the CEO or the founder is the first salesperson, that means at some point or another, he needs to go to the US himself, on the ground, knocking on doors. Maybe it's only for a couple of weeks on a roadshow of business dev, or in some cases, like apiary I just mentioned, or product board, if it turns out that 100% of your customer base is in the US, and you're the best salesperson in the company by factor of being the one most familiar with the product, you will have to consider moving to the US permanently.
You mentioned that when you raise money, it makes it easier to hire great talent, like experienced salespeople. But also on the other side of things, when you want to raise decent amount of money or a bigger sum of money, the VCs require that you have already senior sales talent. So how do you do that?
You know, the answer to it is that, you know, there are different flavors of venture investing, and if you're, depending on the stage you're at, normally companies start from angel investing, so risk profile of investors is changing. So there are some investors who require who can invest at concept stage, at complete seed. There are investors who want to invest only post-product. There are investors who only invest at post-revenue stage. There are investors who only invest at growth stage. So every investor has different appetite for risk, and I think that at the time, early stage investors, or we are talking about seed funds and angel investors. Those categories of investors should accept that the team is far from being complete. It's actually pretty common even at later stages.
I wanted to ask you that: is there a typical ticket size? What's your typical ticket size? I mean the investment size, and what kind of, let's say, MRR requirements you have for companies to get started with them?
Sure. So Credo, we have two tranches typically as a first investment in a company. What we would define as a seed investment, anywhere from a couple of €100,000 up to $1 million, typically. These are companies that most of the time they already have some revenue, but not much. But they have an interesting tech, or they're doing something interesting that's not been done before. And then above this, Series A, where we'll invest up to €2-3 million as a first investment. These are companies they've proven that there's a product market fit for their offering. They are probably in your situation. They now need to become fully professional, start putting in place a real sales team, hire a VP of sales, etc.
Okay. Monthly recurring revenue.
Here, I don't think there's a science to it. To provide expectations, I guess on a seed level, there's no expectation of MRR. It can be anywhere. On the Series A side, these are companies that should start approaching the $1 million of revenue at least, typically.
Okay, thanks.
So we invest initially from 1 million to 5 million with potential to increase to 10 million per company.
Okay. But so the actual level of revenue or MRR is less important than what Marcin was defining as the velocity. The ability to show momentum and closing, and even if it's at a small scale, that's what matters, I think. Because as Marcin said, again, we invest in the future vision, so we will try and project ourselves, okay, what does this company look like in 5 years if I put more money in it? What are the unit economics, and what's the length of the sales cycle compared to the average contract value of each of its customers, for example?
What do you usually, two questions, how much do you usually take for those? What is your range in terms of the equity you take? And that's one. And the second one is, what are the methods you're usually using when you're doing valuations? So more of them, or just
valuation? You can again go back to Christoph Jans if you want.
Sure. So the first question, again, a bit of a science, bit more of an art than a science, but rule of thumb is we want to have a significant stake so that we feel like if the company does well, we'll be incentivized. But we don't want to have too much that the founders no longer control the company and no longer feel like they're incentivized. So again, I'm cutting corners, but 10 to 20% is a good approximation. And but every case is different. And the valuation is even more of an art. And the earlier you go, the more of an art it becomes, because at the seed stage, there's no revenue to start putting multiples on or anything. So it becomes more of a function of how much you need to raise. And again, back to that question of how much equity we want to take for this. If you have these two components, then by definition, you have the valuation, and you try and make it so that that triangle of relationships makes sense, doesn't sound completely out of whack on any of the three legs. At the Series A, it becomes a bit more scientific, or even later on, it becomes very scientific. And again, it's a function of applying a multiple to your MRR or ARR or whatever recurring revenue you have. Ideally, it's recurring. Please come to us with recurring revenue. That's so much nicer. And the growth. And so again, to give you a sense of and to make stereotypes. Enterprise SaaS business, growing, doubling year on year at a Series A stage, you'll give them anywhere between 7 and 10 times revenue if they're growing like that, and annual revenue, obviously, annual recurring revenue.
Thank you.
Marcin, percentage, if you want to comment on that.
Very similar. We are not greedy. The idea is, sharing is great. The idea is to make sure that the team is properly motivated. I think co-investing is fantastic because you have, one more investor who's working hard to help your growth. So typically our minimum is 5. We can take somewhere between 5 and 20. And we are actively active. We are assuming active participation in follow-on rounds.
I have a question related to timing, which was about if you would be a startup, in what product development stage would you approach a VC? As a VC, do you give better conditions for bootstrapped startups? What's your thoughts about that? So, as you said, sometimes it's too late to go to a VC because the competitors are stronger and they are on the market.
So here it's different investors, different appetites. Back to Marcin's point where if you're pre-product, unlikely that a VC would invest unless, we've done it, but it was founders of startups that we've backed previously, exited. Sometimes we actually didn't make money, but still we know that founder, we trust him. So whatever he does, to some extent, we'll back him. Most cases, which is not this, if it's pre-product, that's where you need angels, that's where you need your friends and your family, and your bootstrapping and your crowdsourcing and any other means you can to put together the money to create your MVP, your minimal viable product, and show some form of traction, some form of momentum. Once that happens, then it becomes a function of the stages that each VC investor likes to invest in. I guess always have in mind the size of the fund of the VC you speak with. VCs, it's a very risky business that we do, the investments we do on average. So we always look to invest in startups that can return our fund. Credo, as a 50 million fund, will invest in startups where we start having a feel that they can reach one day $500 million valuation, or maybe less if we have more equity in it, but again, rule of thumbs. So this will give you a sense of the size of the tickets and the maturity that a VC likes to invest in. If you go talk to Sequoia, I think they have a fund of, I don't remember, several billions now. They'll invest much later on in the growth stages. Actually, I think they've started going down, but that's another point.
So our expectation are that we will not invest in a company if we don't see minimum 5x growth potential, and preferably 10x.
So 5 times or 10 times possible return. Yep.
Growth of the valuation.
And it's connected to growth and then to the company growth as well.
Hi. What would VC could offer to startups to help them scale outside of cash itself?
I would say that cash is probably one of the least important elements. You need to have a partner who knows how to help you to grow the business, how to expand internationally, how to grow to the next level, how to establish corporate governance, how to establish processes, how to prepare, how to help hiring, how to establish the team, how to basically prepare the company for the next stage, how to establish the company to be able to talk and accept larger rounds, how to prepare the company to become viable IPO candidate. It's how to prepare the company to become a viable M&A candidate. It is a marathon, and investors generally invest for their lives. Each investor probably made a dozen or a few dozens of investments and went through this process several times. Founders typically do it for the first time, maybe second time. So all ability to get support and assistance in the journey of growing from a startup to exit is probably the most important value.
So, gentlemen, thank you very much. I think that was really valuable. What do you think?